Hi, it's Nero here from Investment Rise, and we've just seen the February data from CoreLogic for Australian property prices. And wow, Australian property prices in the month of February grew at the fastest rate they have in the last 18 years. So that means prices in February of 2021 rose at a faster rate than back all the way in 2003, when prices, mind you, were less than half of what they are today. And if you consider the rate of growth, so on average in February, property prices rose by about 2%. So now if you're someone who was thinking about, is now the right time to buy or not, if you were sitting on the sidelines and you just chose to procrastinate or you didn't take action in the month of February, and if you were looking at a price point of say $500,000, that means that if property prices rose 2%, they rose $10,000. Or put another way, you lost $10,000 by sitting out of the market. Now, that might seem harsh, but that's the reality that we're facing right now. Property prices are rising, and the longer you wait, the more it's going to cost you. But I know that whenever I say this, there are people who are going to say, oh, look, but property prices are so high, and if they're rising so fast, then they're going to fall. And they almost look for excuses or look for reasons to say that the property market will fall. All right. In my last episode, I spoke about JobKeeper and why I don't think that's going to have almost any impact whatsoever. But the other thing that a lot of people are saying is, oh, look, wait till after March. At the end of March, then property prices will start to fall. And why? Well, because a lot of the first homeowner incentives are being pulled back by the end of March. So they're saying that, oh, look, once all those first home buyers are not getting all that free money from the government, then property prices are going to fall, and then we're going to get a bargain. And that kind of rhetoric, that kind of statement can sometimes make sense. And that's why for me, as someone who's now been investing for over 19 years and been helping people invest in property full-time for over 11 years, I just go back to the data, because I want to see if that kind of statement, that kind of so-called conclusion, is actually backed up by data. Right? And to do that, I want to look at two different charts. So let's look at the first chart here. Now, this chart is from the Australian Bureau of Statistics, and it shows the housing loan approvals. Now, I know that some of you have let me know that you don't always watch these videos. You listen to the audio in the car, or you're listening to our podcast, the Property Investing Australia show. So let me just walk you through what this graph says. There are three lines here. There's a dark green line, which talks about the loan approvals for owner-occupiers, which, as you can see, is almost a vertical line up, right? So that means that the rate of housing loan approvals for owner-occupied loans is increasing very, very sharply. Then you have two lines down the bottom. You have the first homeowner line, which is showing a slight increase. And then you have the investor loans as well, which is also showing a slight increase. But the key point is this: the bulk of the demand for housing loan approvals, the bulk of the demand for houses, and the majority of the reason why prices are rising is actually not first home buyers, as you can see from this data. It is actually people upgrading their home, moving out from where they are, changing location as part of the new working conditions in this sort of post-pandemic environment that we're in. And so that's not going to change when first homeowner initiatives fall away, right? So what do I think is going to happen? I think, sure, the rate of price growth may decline in some of our bigger cities. And CoreLogic also say that they expect, especially in Sydney and Melbourne, they expect the rate of price growth to slow down. Now, let me repeat that. They expect the rate of price growth to slow down. So what that means is property prices are still going to grow. They're not going to fall. They're still going to grow. They're just going to grow at a little bit of a slower rate. All right. And where they expect the real bulk of the growth is going to be in our sort of smaller capital cities, like, for example, Brisbane, or your larger regional centres. So that's what this graph shows us. So for anyone out there who says, oh, look, in a moment, first home owner initiatives end, the property market's going to crash, they're not looking at data. They're making, I guess, a conclusion based on a bit of hope. Maybe they do want property prices to fall, and I totally understand that, because I understand at the moment that with the rate at which property prices are rising, there are a lot of people who are going to struggle to get into the market. That is true. And again, I'm not making a judgment on government policy or anything of that nature. I'm just talking about what the property market is going to do. Okay, so when you look at the data, you've got to ask yourself, does it back up these kind of statements that perhaps some of the doomsday people out there, or the people who always think that property prices should fall because after all they're so expensive right now, but yet as we just saw for the data in February from CoreLogic, property prices are rising faster today than they were 18 years ago, when property prices were less than half of what they are today. So clearly the logic that just because property prices are high means that they're going to fall doesn't stack up. It's not stacking up at all. And the longer you wait to get into the market, the data is showing the more it's costing you each and every month. Just last month, it cost you 10 grand. All right. Now, even if that continues but at a slower rate, every month it's going to cost you thousands of dollars because of you not getting into the market, whether it's trying to buy your own home, and certainly if you're trying to buy an investment property as well. But let's just back this up a little bit more, and let's look at this next chart. Now, this next chart, again from the ABS, shows the new loan commitments to owner-occupier first home buyers. All right, and it goes all the way back to 2002. Now, what you can see here is in 2008, at the end of 2008, there was a huge spike in first home buyer activity, because that was at the time when the Rudd government introduced its first homeowner grant, which is about October 2008, as part of its response to the global financial crisis, or GFC, and demand from first home buyers rocketed. But what happened to property prices around that time? Well, if you remember, they didn't do a great deal. Right? There wasn't a huge uplift in property prices just because a lot of first home buyers came in and started buying property, right? Because rates were still high. It was only after interest rates were reduced that property prices started to rise. And that really only started happening towards probably the end of 2011, early 2012. But right now, even with first home buyer initiatives being taken out, we still have record low interest rates. Access to credit has never ever been easier. There is more money in the market for banks to lend out than ever before because of the Reserve Bank's quantitative easing, or QE policy. So from where I'm standing, if you think that first home owner initiatives being taken away is going to crash the market, unfortunately, you're going to be sorely disappointed. I think prices rises are here to stay, maybe not as fast as they have been, especially in Sydney and Melbourne, but some of our other cities, absolutely price rises are here to stay for some time yet. Hey, thanks so much for watching. If you found this video valuable and you're thinking you might like my help to help you find an investment property, then head on over to nerocall.com to discover our unique 5-step process that's helped my private client group purchase now well over $66.2 million worth of property. And then if you like what you see, you can book in for a half-hour phone consult with me personally. Either way, thanks again for watching.